Hey, what's happening, guys? Dan Darrow here with another Options and Play video update. So today's video, I'm going to focus on calendar spreads. Uh, I really feel like this market, right at the moment, is presenting a really interesting opportunity for calendar spreads in general. And I, kind of wanted to talk through, just briefly, calendar spreads again because I have done plenty of videos in the past talking about calendar spreads. So, that's not a unique concept, but I do feel we're kind of at an interesting point um, in the year, and also an interesting point with in terms of volatility, recent volatility for the entire strategy of a calendar spread. So I wanted to go over a little more in depth during this video. So just a quick refresher. A calendar spread is what we call a horizontal spread, right? So a horizontal spread is a trade with the same strike prices but different expirations, right? So that's different than a vertical spread. So a vertical spread would be the same expiration but different strike prices. So a vertical spread would be, say, like January 105 to 110 call spread. Horizontal spread or calendar spread would be 105, a long January 105 call, short December 105 call. So you can see it's the same strike price but different expirations. You stagger the expirations. So with calendar spreads, for a debit calendar spread, the short side of the spread is going to be in near-term expiration or shorter dated expiration, right? And the long side of the spread is going to be in further out or longer dated expiration. Because if you reverse it, then that'll be a credit spread, and that's a different that's a trade for a different day. We can talk about that at a different time. But there are basically two ways to make money with calendar spreads. The first is time decay, right? Theta. So the short-term option should lose value faster because theta, right? Time decay is going to be higher on the shorter dated contract, right? Options that expire sooner are going to have a higher time premium decay than options that expire maybe like a month out or 2 months out or 3 months out. It's options 101. The second way to make money on calendar spreads is with implied volatility changes. So this one's a little bit different. So short-term contracts tend to have higher implied volatility than longer-term contracts. So there's going to be a spread between the two, right? So it's not always the case, but it tends to be the case more often than not. So short-term contracts will have higher implied volatility versus longer-term contracts, which will tend to have a lower implied volatility. And a narrowing of that spread, right? So the short-term decreasing or the longer-term increasing, a narrowing of that spread should help benefit the trade. So now, why is it important right now, right? So obviously the market's been very volatile over the last couple weeks, but also over the last couple months, right? And what we've been seeing is a lot of short-term contracts are trading at really elevated implied volatilities. I mean, we've just in the last week and a half, we've seen multiple days that are with the S&P or the spiders trading in like 4, 5, 6, 7 point dollar ranges a day. So you're seeing really large intraday swings, day-to-day swings. So that means option 101 again, right? So when the market drops really hard, really fast, it doesn't necessarily mean that implied volatility is going to go down. A lot of times it's the opposite. So when volatility increases, the prices of calls and puts both go up. So getting with financials here, you've seen this really sharp drop over the last 2 weeks, right? And what's happened is that near-term expiration contracts have gotten expensive, and it's not just financials. There's plenty of other cases where contracts really short-term, so like this week, next week, the week after, are trading at elevated prices just because it's been such high volatility over the last few weeks. The issue the issue with that right now, though, is that we're actually entering what's historically been a pretty seasonally slow time of the trading year, right? The holiday season. So this week is half over. Next week's a full week, but after that we don't have a full week until the second week of January. So the following week is Christmas, so that's a short trading week, and then the week after that is New Year's. So the holidays, the news dry up, right? So news will be slower, volume will be lighter, and odds are that you're probably not going to see that amount of sustained volatility when half of the people on Wall Street are on vacation. So what you're seeing is near-term contracts are more expensive, but in theory it should actually be the opposite because we're actually entering like a really quiet time of the year. So getting back to financials, why I thought it was interesting and why I just wanted to highlight this. So JP Morgan here is not necessarily a technical development, but it's more about the option dynamics here. So yes, it did get hit hard, really, really quick, really sharp move lower, right? But the contracts for next week, which has a Fed rate decision, so after that, we're gonna kind of be in like a news lull until the beginning of January when the banks kick off earnings season. So what I was thinking is that it's probably a good opportunity to use the more expensive near-term contracts to offset longer-term swings. So maybe through January or February, and the reason is that let's pull up so I can give you an idea here. So the reason is you can see right. So just to use this example, the 105 strike December call. So this expires next Friday. 28.5 implied volatility, right? If you use this as so let's say this as like an example of a straddle, right? Price in about 4.5 through next week. Now, if you go out to January, what you can see is right 25, so under 26. So right there, it's like a 2.5 point implied volatility separation, right? So there's a spread, and this is only pricing in a little under, let's say a little under 8. So for an extra month and an earnings report, right? You're only paying like $4. So it's $4 through next week, and then only 4 on top of that for an entire month and an earnings report. And yes, some of that has to do with the Fed, clearly, right? But it also has to do with like the fact that J.P. Morgan has had this really sharp move down, and options options in J.P. Morgan, options in the banks, options in a lot of things. Really short-term options are expensive. That's because the volatility is really ratcheted higher. So why I thought the banks were interesting is because in terms of earnings season, when we get back, the banks will be one of the first major groups to go, right? So they'll be one of the first to have like significant news flow once we get back and once the calendar switches over to 2019. So that's why I thought they were interesting. But what's the setup for the banks is actually kind of similar for a lot of other things. It's just that the banks will have earnings sooner than most. I mean, tech will be probably about a week to 2 weeks after, so that's why it's a little bit different, and banks are a little bit more like immediate. But I just thought it was interesting to highlight, and I wanted to like show you why calendar spreads are kind of an interesting strategy at the moment and unique for the time of the year because higher volatility into a seasonally really slow time of the year is presenting some opportunities that you don't see very often. So as always, I'd love to hear from you guys. Questions, comments, pass them along. I'm feeling a little bit better today, so not as much of a frog voice, and hopefully continue to improve. So as always, have a great night, and I'll talk to you guys tomorrow.